previously had an agreement with Secretary Yellen to have a hard stop of 1:30 p.m. for this hearing, which is consistent with committee precedent. She has since informed us that she has a meeting at the White House that she needs to get to, so the hard stop will now be at 12:30. Democratic members who were unable to ask their questions of Secretary Yellen at the last hearing that she testified at will get priority today in the question order, and I hope that we can get to everyone, even with the truncated hard stop for today's hearing. This hearing is entitled The Annual Report of the Financial Stability Oversight Council. I now recognize myself for 4 minutes to give an opening statement. Good morning and welcome, Secretary Yellen. Thank you for testifying today on the annual report of the Financial Stability Oversight Council, or FSOC. Before the 2008 financial crisis, no governmental body was solely responsible for identifying and mitigating systemic risks across our financial system. As a result, our economy was unprepared for a near collapse of the financial system, which resulted in 8 million foreclosures, 9 million people unemployed, and the loss of $19 trillion in household wealth. In response, Congress passed the Dodd-Frank Wall Street Reform and Consumer Protection Act of 2020 and established FSOC to identify emergent vulnerabilities and mitigate threats to our financial stability. And for its first few years, FSOC took important steps to address turmoil in our financial system, including subjecting massive insurance companies like AIG to stricter oversight. Unfortunately, the Trump administration undermined FSOC by cutting staff, conducting fewer and shorter meetings, and removing regulatory safeguards on risky mega financial institutions. The good news is that Secretary Yellen and FSOC are taking steps to repair the damage that was done by Trump and to focus on clear threats to our economy, including finally labeling climate change as a systemic risk. I urge the Secretary to also restore FSOC's ability to guard against the threat of systemically important financial institutions. Big tech, crypto, and so-called shadow banks are causing significant and fast changes in our economy. So FSOC must remain vigilant in its ever-changing environment. Maintaining a strong economy has been a key goal of my committee, particularly for communities of color. The 2008 foreclosure crisis was caused by banks steering borrowers who were disproportionately people of color into predatory mortgage products. History almost repeated itself during the pandemic as millions of families almost lost their homes to evictions through no fault of their own. I'm proud to have fought hard with my colleagues to secure $46.6 billion in emergency rental assistance. I'm proud that by June, Treasury estimates that states and localities will have successfully spent or obligated all of those funds all across America. But the housing market needs more support. Home prices rose nearly 19% in 2021, and despite the recent interest rate increases, prices remain high. Housing now accounts for a core part of inflation. It is clear that we must do more to increase our nation's supply of affordable housing. This is why I drafted and continue to advocate for the historic housing provisions of the Build Back Better Act. Finally, our economy can only be strong if everyone can participate, and that includes America's women. The Supreme Court's forthcoming decision to overturn Roe v. Wade would threaten the financial security of women and our nation's economic stability. I applaud Secretary Yellen's leadership thus far and look forward to her testimony. I now recognize the ranking member of the committee, the gentleman from North Carolina, Mr. McHenry, for 5 minutes.
Well, Madam Chair, let me begin by saying welcome back. We're glad you've recovered and recovered so well. Glad to have you back in health and welcome you back. And also grateful that our vice ranker is healthy as well. We know that COVID is still very real, but very grateful that both my friends on either side of me are healthy. Secretary Yellen, welcome. Thank you for being here. The Financial Stability Oversight Council, or FSOC, is charged with identifying and responding to emerging risks to our financial system. That was the design of it. FSOC does not and should not impose partisan policies. So today, Secretary Yellen, I think we should be focused on the challenges posed by Russia's invasion and the consequences to the global economy, the impact that China's lockdowns and economic issues will have on the financial system and the broader economy, the importance of protecting the financial system from bad actors and foreign adversaries, including cyber threats, and the performance of domestic financial markets over the last several years. That should be the FSOC's agenda, but it isn't the FSOC's agenda. It seems that FSOC has become an arm of the administration's policy agenda rather than the objective body evaluating real risk to the financial system. In fact, much of what the FSOC has proposed to examine and what the Democrats will discuss today is part of the left's political agenda. Secretary Yellen, the economy is at a crossroads. Democrat-led Washington, Democrat regulators, and Democrat policies are failing the American people. In the first quarter, our economy shrank. The GDP came in at a negative 1.4%. Democrat policies have helped fuel a surge of imports and a decline in business inventories, both of which detract and reduce the economy. Adding to the problem is a record 11 million jobs available. Yet workers are still on the sidelines because inflated wages are eroding the ability of the private sector to hire employees to match production demands. The roots of the problem are out-of-control Democrat spending, which has created persistent inflation. In fact, just yesterday, the Bureau of Labor Statistics announced that inflation rose again in April. It's now at 8.3% over the past year, remaining near a 40-year high. Inflation is killing American consumers' household budgets. Wages are not keeping up with inflation and the rising cost of things that families buy. Instead of addressing the issues of rising prices and what those problems are creating for the economy and the American families' financial well-being, Democrats will focus elsewhere. Deep down, they know that their spending spree is hurting America. But pulling back all that free money isn't popular, and the midterms are looming, so they don't want to do that. You would think that my colleagues across the aisle would take this moment and reflect on their agenda and its effectiveness, or lack of effectiveness. Instead, they're doubling down and using the FSOC to advance their radical policies. So you don't like something? Well, let's just have the FSOC label it as risky and regulate it away. And before you know it, progressive policies will force lending decisions in favor of those customers who are activists and progressive support, while law-abiding American businesses will be forced to close to appease the radical left. Let's turn now, though, to an issue that is of consequence to the stability of our economy. Let's turn to digital assets and stablecoins for a moment. This week, we've seen dramatic volatility within a particular algorithmic stablecoin. And by its nature, it is not stable when it doesn't have backing by something real and of substance. And I want to be clear that not all stablecoins and not all digital assets are the same. This example this week is a clear sign to the broader world that that is true. Not all these assets are the same. Nor should they be regulated the same. And in fact, we have no regulatory sphere or recognition of digital assets. We don't have a federal regulatory regime for stablecoins, and we need it. And I think there's bipartisan understanding of that. Beginning last year, I made clear to this committee we need to come together to establish a clear regulatory framework for stablecoins and the broader digital asset ecosystem. It's time for Congress to act on these important markets and provide stability. It's very important in the short term and long term, and these technologies deserve time to be understood before they're labeled as risks. Madam Chair, thank you, and I yield back.
Thank you very much, Ranking Member McHenry. I now recognize the chairman of the Subcommittee on Consumer Protection and Financial Institutions, the gentleman from Colorado, Mr. Perlmutter, for 1 minute.
Thank you, Madam Chair. Madam Secretary, good to see you. I want to highlight one of the issues raised in the Financial Stability Oversight Council's annual report. Colorado continues to see increased climate-related risk in the form of more wildfires. In December, the Marshall Fire burned nearly 1,100 homes, businesses, and other structures, making it the most destructive fire in Colorado history in terms of property destroyed. The cost to rebuild our communities is daunting, and nearly every homeowner was underinsured. When it comes to climate risk, you can already see the effect on the insurance market in the state of Colorado. On Monday, I held a telephone town hall with almost 7,000 people on the line. We conducted a poll question: how concerned are you about wildfire risk on a scale of 1 to 5? And every single respondent answered with the highest level of concern. We must ensure our financial system serves as a source of strength as we seek to address climate change. With that, I yield back.
Thank you very much. I want to welcome today's distinguished witness, the Honorable Janet Yellen, Secretary of the Department of the Treasury and Chairperson of the Financial Stability Oversight Council. Without objection, your written statement will be made part of the record. You will have 5 minutes to summarize your testimony. You should be able to see a timer that will indicate how much time you have left. I would ask you to be mindful of the timer and quickly wrap up your testimony. Secretary Yellen, you are now recognized for 5 minutes to present your testimony.
Thank you, Chairwoman Waters, Ranking Member McHenry, and members of the committee. I'm pleased to speak with you today about the Financial Stability Oversight Council's 2021 annual report. The report is a collaborative effort of the council member agencies. It's a vehicle for providing Congress and the public with the council's collective assessment of potential risks to U.S. financial stability. And today, I'll highlight a few topics in the report and provide an update on the council's activities since the report's publication. First, the report discusses vulnerabilities in the non-bank financial sector, which were highlighted by the turmoil in financial markets in March 2020. While the Dodd-Frank Act reforms increased the resiliency of the U.S. financial system, the market turmoil in March 2020 demonstrated that the liquidity mismatch and use of leverage by some non-bank financial institutions can make them vulnerable to acute financial stresses, and these stresses can be transmitted and amplified to the broader financial system. The Council has taken steps to examine these risks, including reestablishing its hedge fund working group to develop an interagency risk monitoring system and to propose options to mitigate identified risks. And earlier this year, the Council issued a statement to express support for the Securities and Exchange Commission's efforts to reform money market funds and their work to consider potential reforms of open-end funds. The Council is also working to support improving the resilience of the Treasury market and is coordinating with the Interagency Working Group on Treasury Market Surveillance. Potential steps to be taken include improving data quality and availability, evaluating expanded central clearing, and enhancing trading venue transparency and oversight. The SEC has proposed certain reforms to enhance transparency and oversight over alternative trading systems that trade government securities. The SEC has also proposed updating the definition of a government securities dealer to include market participants that play an increasingly significant liquidity-providing role in overall trading and market activity. Additionally, the Office of Financial Research is working to fill identified data gaps for uncleared bilateral repurchase agreements through a pilot data collection, which should improve visibility into a major source of financing for non-bank financial institutions in Treasury markets. Additionally, the Council is working to ensure that financial institutions better understand their climate-related financial risks. In its October 2021 report on climate-related financial risk, the Council outlined how climate change can be a source of shocks to the financial system and increase risks to financial stability. To address these risks, the Council recommended that regulators build their capacity and expand their efforts to address climate-related risks, improve the availability of data, enhance and standardize disclosures, and assess and mitigate risks to financial stability. The Council has also formed its staff-level Climate-Related Financial Risk Committee, which will serve as a coordinating body for the Council to share information, facilitate the development of common approaches and standards, and foster communication across FSOC members. In addition, the Council is establishing the Climate-Related Financial Risk Advisory Committee. This advisory body, which will include a broad array of external stakeholders, will help the Council gather information and analysis on climate-related financial risks. With respect to digital assets, new products and technologies may present opportunities to promote innovation and increase efficiencies. However, digital assets may pose risk to the financial system, and increased and coordinated regulatory attention is necessary. On March 9th, President Biden signed an executive order calling for a comprehensive approach to digital asset policy. And the Council is drafting a report that will identify financial stability risks and regulatory gaps. I look forward to working with you on the issues and opportunities posed by digital assets. And we're also eager to work with you to ensure that payment stablecoins and their arrangements are subject to a federal prudential framework on a consistent and comprehensive basis. Finally, there's the potential for continued volatility and unevenness of global growth as countries continue to grapple with the pandemic. Russia's unprovoked invasion of Ukraine has further increased economic uncertainty. The U.S. financial system has continued to function in an orderly manner, though valuations of some assets remain high compared with historical values. We stand firmly with the people of Ukraine and have implemented an unprecedented suite of sanctions on Russia that have been implemented by financial institutions. On February 28th, I convened the Council in the wake of the invasion, and we will continue to monitor developments and coordinate actions as the risks and threats evolve. The Council's report also discusses other potential emerging threats and vulnerabilities that the Council continues to monitor, including short-term wholesale funding markets, central counterparties, alternative reference rates, cybersecurity, corporate credit markets, and real estate markets. The Council remains committed to its mission of identifying and responding to risks to U.S. financial stability, and I look forward to working with this committee to promote a more robust and resilient financial system. Thank you.
Thank you very much, Secretary Yellen. I now recognize myself for 5 minutes. Secretary Yellen, according to a recent study by the Gates Foundation, family planning increases a woman's earnings and control over their own assets. As you know, we recently became aware of an imminent decision regarding the landmark case of Roe versus Wade. Arguably, the single most important decision regarding a woman's economic sovereignty is in jeopardy. A study from the University of California, San Francisco, found that women who were unable to get an abortion were more likely to have more debt and to suffer crippling financial events like eviction or bankruptcy. Secretary Yellen, how might the Supreme Court's reversal of Roe versus Wade impact our nation's financial stability and the economic opportunities available to women?
Thank you for that question, Madam Chairwoman. I believe that decades of research have established that there's a causal link between access to abortion and the quality of women's lives. It affects their education, their earnings, their careers, and the subsequent life outcomes of their children. And I believe that overturning Roe would prevent large numbers of women from managing their reproductive lives, particularly many low-income and financially vulnerable individuals. The inability to access abortion would have a profound impact on their personal and economic lives. There have been studies that show that denying women access to abortion increases their odds of living in poverty or their need for public assistance. And in the recent Supreme Court case, there were a group of economists who submitted an amicus brief that summarizes the economic research that establishes the relationship between legalization of abortion, birth rates, women's educational attainment, job opportunities, and found very significant impacts.
Thank you very much. Secretary Yellen, in FSOC's most recent annual report, FSOC noted that financial innovation has the potential to bring benefits to the public, but it can also create new risk. The report noted that many digital assets are speculative and volatile, creating risks related to illicit finance, cybersecurity, and privacy. Further, the report noted that stablecoins, in particular, may pose systemic risk if the stablecoin is not adequately backed, and there is a run on that stablecoin by investors, resulting in a fire sale of reserve assets and similar runs on other stablecoins. While I appreciate the President's working group has called on Congress to pass legislation focused on stablecoins, we are exploring various ideas. FSOC has tools at its disposal to address some of the systemic risk concerns relating to digital assets. What is FSOC doing with its existing authorities to ensure that cryptocurrencies, including stablecoins, do not pose a threat to our financial system?
Well, the Financial Stability Oversight Council has been tasked by President Biden in an executive order. The executive order is on ensuring responsible development of digital assets. It calls for a number of reports by Treasury, but FSOC is charged with producing a report that looks at financial stability risks particularly. And we're working very hard on that. It will address the risks that these assets pose. The Treasury report will address many of the risks that you identified in your question. But on the issue of stablecoins, which is a kind of digital asset that is intended to have a one-to-one relationship with the dollar, the President's working group on financial markets regarded it as frankly urgent to push ahead to write a report making recommendations to Congress. We've called for Congress, and I hope this would be a bipartisan effort, to produce a comprehensive framework for the regulation of these assets. There are potentially useful innovations that could make the payment system faster and more efficient, but we really need a regulatory framework to guard against the risks. And just this week, in the last couple of days, we've had a real-life demonstration of the risks. A stable coin, so-called algorithmic stable coin, known as Terra, broke the buck. And this morning and yesterday, the largest stable coin, Tether, also briefly broke the buck.
Thank you very much. The gentleman from North Carolina, Mr. McHenry, who is the ranking member of the committee, is now recognized for 5
So
minutes.
let's continue with that theme. We saw one stablecoin that's purported to be backed with assets broke the buck, and we have one algorithmic stablecoin that broke the buck. Do you make a distinction between an asset-backed stablecoin and an algorithmic stablecoin?
Of course, there are significant differences between these two.
Well, I welcome the President's Working Group report that your group put forward to Congress and to the public about regulating stablecoins. And so I think it's important that we have a federal framework and federal law around something that purports to be U.S. dollar. That is a proper remit for the Federal Reserve and for Treasury. Your opinions matter significantly as we legislate here. And as I said in my opening statement, I called for us to get on with this question a year and a half ago. So I welcome the report, and I think we should get to work here. But along those lines, in your mind, how does limiting stablecoin issuances to only banks promote innovation?
I think that creating a framework that is appropriate to the risks that stable coins present really provides the kind of certainty about the regulatory environment that issuers of stable coins need to thrive and to innovate. In our discussions with the industry, one of the complaints that we typically heard was that there's regulatory uncertainty. And if Congress were to establish a framework, it would make it easier for the issuers of these assets to know what the regulatory environment would be.
So the President's Working Group contemplates that these would be issued only by banks. Is that your view? And if these are risky assets, why does putting them in a bank actually de-risk?
Well, one of the key financial stability risks associated with stablecoins is that they can experience runs, and we've seen that.
But if they're one-to-one backed, as the President's Working Group says, with high-quality liquid assets, high-quality bank assets, in essence, you don't have runs if you have one-to-one backing with cash or cash equivalents.
Well, we have money market funds, and money market funds are very similar in many ways to stable coins, and they have been a source of instability in the financial system.
And there's been 42 years of regulatory fights over money markets. What we're trying to do here is make this a very straightforward, stable product.
And that's what bank regulation has accomplished, I believe, in the United States.
But Dodd-Frank was about de-risking the big banks, and now the President's Working Group contemplates that we're going to add more risk to these institutions. So my question is it a viable path for us to have a one-to-one backing here of a stable coin and it not have to be domiciled within a bank?
Well, the President's Working Group contemplated different alternatives and unanimously recommended the establishment of a bank framework for regulating stable coins.
A bank framework.
It's a flexible framework. It involves appropriate capital and liquidity requirements, which I think are important, and is a framework in which payment system risks can be addressed.
Yes.
I think this
and
is
we welcome
something
that.
that would be working on a bipartisan basis to discuss alternatives and evaluate them is something that I think would be very worthwhile, and I would urge this committee to engage in. We would be very
We welcome
glad
that.
to work
Now,
with you.
one larger question here, because we're talking about the Financial Stability Oversight Council and the view. We have an inflation that's raging. We have growth that's stagnant right now with the latest numbers and rising gas prices. What's your administration doing to take on these challenges the American people are feeling and what my constituents are talking to me about?
Well, clearly inflation is a very substantial issue, and I agree with the President's assessment that it is really the #1 economic issue that faces the administration and the nation. It's having a substantial adverse impact on many vulnerable households, and we are laser focused on addressing inflation. As you know, the Federal Reserve plays an important role. They're charged with price stability and full employment. And I would say first and foremost, it's the Fed's responsibility, and we support an independent Fed making the judgments that they think are appropriate. For our own part, the administration is taking a wide range of steps to do what we can to address inflation, and that ranges from things like releases from the strategic petroleum reserves that are substantial, that are intended to bring down energy prices, and working on supply chain issues that are contributing.
Thank you very much. The gentleman from Connecticut, Mr. Himes, who is also the chair of the Subcommittee on National Security, International Development, and Monetary Policy, is now recognized for 5 minutes.
Thank you, Madam Chair, and thank you, Madam Secretary, for being with us. I want to continue this conversation on stablecoins because obviously the activity and the volatility of the last couple of weeks have been interesting and concerning to watch. But I do, since this is the first time we've had you here since we've had really a pretty substantial and robust recovery from the economic devastation of COVID, I do want to take just 30 seconds to reflect on Dodd-Frank and what it meant. I'm in the minority of panel members who were here when that legislation was crafted. And I remember how very much it was sort of the ugly stepchild of legislation coming out of '09. We were assured by my Republican friends that it was going to end capital markets in this country. Liquidity was going to dry up. Credit availability was going to be gone. The entire capital markets of the United States was going to migrate to Europe and Asia. Of course, none of that happened. The banks are much more profitable and larger today than they were at the time. We've seen innovation. To be fair, on the other side of the aisle, there were people who were concerned that at the first time of trouble, the financial sector was going to crumble. That didn't happen either. In fact, we just went through the mother of all stress tests. We saw economic stress, unlike what we saw back in '07, '08, and what didn't happen, the sector did not come down. So I just wanted to take a minute to just offer an encomium to the hard work that was done back when Dodd-Frank was being crafted. Let me turn, though, back to this really interesting conversation. Some people estimate that there's been as much as $1 trillion in value lost in a variety of different stable coins and other coins, other cryptocurrencies. I feel the pain of those who lost money, but this is also an education for people who thought that Bitcoin grew to the sky. I'm not sure there's any regulation we can pass that is quite as much of an education for investors as seeing what volatility and risk look like. So my question, Madam Secretary, is what does worry me as a veteran of Dodd-Frank, at what point do we see systemic risk developing in this sector, and what does that look like? I don't think that at $2 trillion in market cap we're talking about systemic risk, but I could be wrong. Where do you see the possibility for systemic risk developing in the broader cryptocurrency realm?
Thank you. Well, the Financial Stability Oversight Council is analyzing right now, in response to the President's executive order, potential financial stability risks from digital assets writ large. But we have already issued a report, the President's Working Group, which is a subset of the FSOC, on stable coins, because although I can't say that they have reached the scale right now where they're a financial stability concern, And we're seeing Terra having broken the buck, and Tether under some pressure as well, which is the largest one. I wouldn't characterize it at this scale as a real threat to financial stability, but they're growing very rapidly, and they present the same kind of risks that we have known for centuries in connection with bank runs. They're assets that purport to guarantee conversion at will to the dollar on a one-for-one basis. And
let me interrupt you. Thank you. The answer, I was looking for validation that at $2 trillion in overall market cap, we're not talking about systemic risk. So let me just ask you to go on. Again, being a veteran of the meltdown of '08 and Dodd-Frank, I get very, very itchy around systemic risk. So, and actually, of course, that market cap has decreased dramatically in the last couple of months. So at what point should this committee get focused on the possibility of systemic risk? Are we talking $5 trillion in market cap, $10 trillion? At what point should the red flag start to rise?
I mean, I can't give you a numerical cutoff, but what I do see is that the use of digital assets is rising very rapidly, that they present the same kinds of risks, of run risks and other risks, payment system risks, and really we need a comprehensive framework so that there are no gaps in the regulation.
Agreed. In my final 30 seconds, thank you. I want to leave you 30 seconds. I've been doing a lot of work on a central bank digital currency, which, as you know, the Federal Reserve has opined on in a general way. In my remaining time, a central bank digital currency, in as much as it was a liability of the Federal Reserve, would do away with a lot of the concerns that we're talking about here with stablecoins, correct?
I agree with that. That is a reason to want to have the central bank digital currency. But there are also concerns because it could have a very, depending on how it's designed, a very significant impact on the structure of financial intermediation. So there are some trade-offs here. We will address this in the Treasury report that we'll be issuing.
Thank you. Thank you very much.
Excuse me, members. I'm going to ask you to keep your questions within your 5 minutes, and I'm going to ask the Secretary, based on the fact that you've got to get out of here, and I'm trying to accommodate all of our members who were not accommodated before. Let's keep within the 5 minutes. Thank you very much. The gentleman from Missouri, the gentlewoman from Missouri, Mrs. Wagner, is now recognized for 5 minutes.
Hi, thank you, Madam Chairwoman. Secretary Yellen, thank you for joining us today. During a public address on Tuesday, President Biden attempted to once again blame record-high inflation on the pandemic and Putin. Secretary Yellen, is it still your belief that excessive government spending, trillions of taxpayer dollars, is not a root cause of the rising prices that my constituents in Missouri's 2nd Congressional District are seeing for every single day on gas, goods, groceries? I could go on and on. Is it not a root cause?
Look, there are many contributors to the exceptionally high inflation that we're experiencing. And certainly
is excessive government spending a root cause?
Look, we had substantial programs to address what I believe was the most significant risk we faced as an economy at the time. Unemployment was extremely high.
It has now spun us into an inflation that is a 40-year high, goods and services that are not affordable in any way, shape, or form. We've literally had the CPI down for one quarter. God help us if it's down for a second one. Could toss us into a recession, supply chain issues. I could go on and on. Look, we have spent trillions and trillions of dollars, and the Fed has been too late to get here to help. Is the excessive spending a root cause?
Well, look, inflation is a matter of demand and supply, and it's certainly true that government programs supported demand.
Ma'am, let me just reclaim my time.
Let
let me just reclaim my time here, please, and since we'll move on since you won't answer the question. The ranking member asked also about inflation and asked what you and the administration are doing about it. And you assured us it's all hands on deck and you're doing all sorts of things. You identified that, in fact, there's a problem with inflation, but what are you doing? What are you and the president specifically doing? All you said was you were releasing oil from the Strategic Petroleum Reserve, which does nothing to help and actually jeopardizes our future petroleum needs when there really is an emergency. What are you doing specifically?
Well, the release from the Strategic Petroleum Reserve has served to hold down oil prices.
No, it
above
hasn't.
I'm sorry, but it has.
It's $4.50 a gallon, and diesel's well over $5. It's a drop in the bucket. What are you doing specifically? You said it's all hands on deck.
Well, Russia's unprovoked attack on Ukraine has had a substantial impact
Oh, for
on
heaven's
global
sakes.
energy.
We've
and
been at this
food
for
markets.
16 months, Madam Secretary. I mean, with all due respect, I can't disagree more. You won't even admit that the root cause of this is the spending and spending and spending. The Fed just got on the job last month in terms of, raising by 50 basis points. We'll do it again next month, and perhaps the month after, and the month after. We are in a spiral. I mean, the moms in my district can't find baby formula, okay? They can't afford to fill up their cars with gas.
Well,
this is a serious situation, and making, what else are you doing besides the Strategic Petroleum Reserve, ma'am?
Well, we're trying to unblock supply chains that have become very clogged, but we've, put in place changes, for example, at the ports of Los Angeles and Long Beach that have substantially diminished backlogs there that have been raising prices and taken steps.
How about some energy independence instead of, let's open up Keystone. Let's get some of these oil and natural gas leases through so we can be once again energy independent, not only take care of our own energy supply and needs, but also maybe provide that to Europe so they're not so dependent upon Russia and Iran and other dictators. There are so many things, ma'am, that we should be doing. And the problem with unclogging the ports is then they're paying $5.50 to $6 to move that in diesel to St. Louis, Missouri, in the middle of the United States. It is untenable, is unacceptable, and it is unbelievable to me that we can't even get the Secretary of the Treasury to admit that overspending by this administration is the root cause. I yield back.
Thank you.
Sadly.
The gentleman from Massachusetts, Mr. Lynch, who is also the chair of the Task Force on Financial Technology, is now recognized for 5 minutes.
Thank you, Madam Chair. Madam Secretary, thank you for being here. We really appreciate all your good work. I want to follow up on Mr. Himes' question. I know he ran out of time sort of at the end. But I can't help but make a comparison to what we're seeing in the stablecoin area with an earlier part of our history when individual companies, coal companies, railroads, lumber companies were issuing their own script. And what happened with all those privately issued currencies was that when the greenback came out, consumers and businesses recognized the stability in the greenback, and all of those script currencies went away. Some of them were banned by the Fair Labor Standards Act and other pieces of legislation, but some went out of disuse. Right now, there are 200 stable coins in circulation. What are your expectations that 200 stable coins are going to survive the emergence of a CBDC issued by the Fed?
So I think the risks associated with the proliferation of private stablecoins, you've described that extremely well, and I agree with it. And I think a benefit of issuing a central bank digital currency would be that it might diminish the proliferation of these stable coins. But it depends on the design of exactly how the central bank digital currency is introduced. There are a variety of design choices there, and there are issues around that. Privacy is an issue. If a central bank were to issue it directly to consumers in order to protect against illicit finance, against CFT, AML type considerations. There would be privacy concerns for the Fed amassing that data. An alternative that would seem more likely to me would be relying on financial institutions to play a role in dealing with customers. All of that would affect stable coins, but there could continue to be stable coins that coexist with the central bank digital currency. They may offer some benefits in terms of faster and more efficient and cheaper payments. I think we should be open to innovation, but it is an argument for a CBDC.
I agree. So the one aspect that you alluded to is the disintermediation of the commercial banks. If the Fed was going directly to the consumer, we don't need commercial banks, and they wouldn't have a role here.
It could draw a lot of funding away from the banking sector.
Right.
If it's a very attractive asset. And, you know, this is something under consideration in many countries around the world.
I do want to go on to one other, and I appreciate the thoroughness of your answer. One of the things I worry about is that many of these stable coins being issued are issued with nothing more than a white paper. And trying to go through that, even with an engineering degree, is extremely difficult. And I go back to the mission of your agency and of FSOC, and the asymmetry between the issuer of the stablecoin and the customer. Is there not some way that the regulators can intervene to make sure that, at least when they issue a currency, that there is some basis of judgment on the part of an educated consumer on the viability of that individual instrument?
Well, we would like to see a comprehensive federal regulatory framework that could ensure that that information is available and there's a regulatory framework that would be in place. I really urge bipartisan action on this. At present, there are some agencies that have some authorities here. I don't want to opine on whether or not, say, the CFTC and SEC may have some regulatory authority here. We would like to see a comprehensive framework.
So would I. I just want to say that I am aware that the Boston Federal Reserve is working with MIT on that Hamilton project, which is also one of the...
Yes, on the technical, it would be a long time before it could be introduced, and that works on.
I
it.
yield back,
Gentleman
Madam
from
Chair. Thank
Texas,
you.
Mr.
Thank you.
Sessions is now recognized for 5 minutes.
Madam Chairman, thank you very much. Secretary, thank you for taking time to come up to us on the Hill. You're going to be bet my reality up at this committee. And the reality is that the way I see it is things are not working. I will go back to President Clinton, who admitted before the joint session of Congress, the era of big government is over. President Clinton came in, tried to do exactly these same things, and then found out it didn't work. President Obama stated, it's just not working the way which we wanted. And I would say to you, it's a question, is the economy and the success of an economy an art or a science?
It's an art and a science, but I would say to you that from the point of view of the ability of our economy to produce goods and services and promote the well-being of Americans.
Then that is a science, because we, just like understand education, you can see what's good in education, you can see where somebody's headed to trouble. What you're talking about, art, to me, is politics. And today, this committee and you began going into art, not science. You went into abortion. You went into a stable coin rather than the general market, rather than the things which you are responsible for, which is science, which is policy, which is those things that make sense and are well-worn ways in a free enterprise system. I think that what you've got to do is have a dose of reality, Madam Secretary. You're bound to have somebody in this council who can offer some advice that what we're doing, going back to President Obama or President Clinton, it's not working. What works is getting people in a free enterprise system to go to work. OPM has yet, if you look at their website, to give instructions for the government workers to go back to work. If you do not have the government working and you're leading the way, how can you expect others to go to work? Now, it's true, I'm from Texas, and in Texas, we are working. We are doing those things. We had an equal amount of COVID issues and problems with the rest of the United States. But my point would be that I think in your own opportunity to look at the San Francisco Fed, they directly pointed to the $1.9 trillion rescue plan as causing inflation. I openly say it, and I'll say it again. I think this administration, I think this Congress is making friends with inflation. I think they're doing the things that cause it, and that it is a science, not, and it's being treated as an art. Please defend that issue yourself.
Well, I think that the American Rescue Plan played a hugely important role in putting people back to work and ensuring that people throughout the pandemic were able to keep roofs over their heads and food on the table. And think about the set of problems we do not have because of the ARP. We do not have starving families and children.
How many jobs are available in the market today that are unfilled?
We have an extremely strong job market, and that owes importantly to the ARP. If you remember the recovery from the...
How many jobs are going begging? And your statement tends to imply jobs aren't available, and so the government has to do it. The government has to pay the money because people need it. Well, how about jobs? How about free enterprise? How about people paying into the Treasury as opposed to taking out a loan? This is that art versus science that I'm talking about. And I would suggest that you invite a couple members of the committee that are on this side to come meet with the council if they can't hear this. They need to get reality. President Clinton had it right. The Arab big government was supposed to be over. President Obama, it's just not working the way we thought. This is a science, not an art. I thank you for being here. I'm available to meet with them also, and I yield back my time.
Thank you very much. And this committee is not making friends with inflation. The gentleman from New York, Mr. Torres, is now recognized for 5 minutes.
Thank you, Madam Chair. Madam Treasury Secretary, a few months ago, I asked the Chair of the Federal Reserve about the risk of stagflation. And since then, in the first quarter of 2021, the economy shrank by 1.4%, and last month, inflation rose by 8.3%. Given these two developments, how high, in your view, is the risk of stagflation?
I'm sorry, could you just repeat?
How high, in your view, is the risk of stagflation?
Is stagflation,
Yes.
Did you say? So we clearly have high inflation, and the Federal Reserve has a critical role to play in bringing that down. They're in the process using their own independent judgment of tightening monetary policy to do so, and the administration is doing what we can to also address supply chain issues and other contributors to inflation. We have a really good, strong labor market. We have household balance sheets that are in good shape. We have companies that, although, as we note in our annual report, have a lot of debt, the interest costs on that debt, it's very able to service it, and we have a very strong banking sector. And all of those things suggest that the Fed has a path to bring down inflation without causing a recession. And I know it will be their objective to try to accomplish that.
I have a question about improper payments. The rate of improper payments in the federal government has risen to levels never seen before. According to OMB, the improper payment rate for unemployment insurance in FY 2021 rose to 8.7%, and there have been reports that the percentage could be even higher. In June of 2021, Axios had an alarming headline: half of the pandemic employment money might have been stolen. I know the Treasury has the Payment Integrity Center of Excellence. Does the center have the authorities, capabilities, and funding it needs to confront the growing crisis of improper payments?
Well, I think that different agencies have different authorities in terms of looking into that and trying to address improper payments. Some of that authority for some programs resides with the Treasury, and we are doing everything that we can to make sure that the payments that we're making under the programs that are our responsibility are not characterized by fraud. We have inspector generals and fraud prevention programs and controls in place to address
I just want to quickly interject. Is the Payment Integrity Center of Excellence, is its authority restricted to the Treasury, or is it government-wide?
I believe a number of different agencies, and of course DOJ plays an important role there as well.
The supply chain disruptions have been so severe that parents are desperately searching for baby formula, which is in dangerously short supply. As you know, some parents have had to travel long distances to purchase baby formula. Other parents have had to ration formula or water it down, and others still have fallen victim to price gouging or panic buying. And according to the New York Times, the out-of-stock rate for baby formula has risen to 43%, up 10% from just a month ago. What can be done in the short term to alleviate the shortage of baby formula?
I wish I had a good answer for you, but what I can promise you is that the administration is carefully looking into this and will certainly do what they can to address what is a very disturbing finding that you described.
A quick question about stablecoin. Suppose for a moment there's a stablecoin issuer whose reserves are verifiably backed by the dollar on a one-to-one basis, and whose reserves can be immediately redeemed for a dollar on a one-to-one basis. If the stablecoin issuer has no fractionalization of reserves and has no lending, it would seem to me that the stablecoin issuer is operating differently from a bank and therefore should be regulated differently from a bank. Is that a fair assessment, or what is your view on that?
Well, certainly. There are differences, and different banks operate differently and present different risks.
But a bank, by definition, has fractional reserves and lending function, which are lacking in the case of stablecoin issuers, right?
Well, that suggests that a slightly different model should apply in regulating them. A bank framework has the possibility of flexibility to address the differences.
Thank you very much. The gentleman from Florida, Mr. Posey, is now recognized for 5 minutes.
Thank you, Chair Waters. With the Federal Reserve embarking on their fight against inflation, it appears we're entering a period of increasing interest rates. How much will 1, 2, or 3 percentage point increases in our interest rates end up increasing the interest on the national debt, and what actions are you planning to take in that regard?
So at the moment, the real interest on the national debt over the last couple of years has been negative because nominal interest rates have been so low. In our own projections of the interest burden of the debt in the years ahead, we've assumed that interest rates would not stay at that low level, and we've projected increases. Even so, you can see in our mid-session review, and we'll be updating or in the I guess the last budget, and we'll be producing another mid-session review where we update our forecast interest rate path. The real interest burden of the debt remains below 2%, which is a level that many economists regard as safe and consistent with solid government finances.
Last October, the Financial Stability Oversight Council issued a report on climate change. The consistent position comes through that the FSOC wants to rely on scenario analyses to assess climate risk. I believe we must also recognize that regulators and forecasters oftentimes make errors as well. Will your scenarios provide for assessing the potential adverse impacts of regulatory decisions if they turn out to be ill-advised or based on overly pessimistic climate scenarios?
Well, you know, I think it's important for financial institutions to be prepared to have adequate capital liquidity to address a variety of risks, shocks that can hit the economy. No one ever expected a pandemic, but the Dodd-Frank rules that were put in place ensured resilience of the financial sector, of the banking sector, to be able to survive shocks and meet the credit needs of the economy. And similarly with climate change, we don't know exactly how things will transpire, but we want to make sure that with adverse scenarios remaining possible, that banks operate in a way that's safe and sound. So scenarios are widely used around the world in evaluating the vulnerability of banking organizations to the risk from climate change, and we're learning from what other regulators do. And regulators of banking organizations are looking to such scenarios to evaluate the range of risks that we could face.
Could you tell us who some of these foreign regulator experts are that we're relying on, that we're learning from?
Well, I'd say the Bank of England is most advanced in devising scenarios and using them to evaluate the safety and soundness of their banking organizations. And there is a network of central banks that have worked on designing scenario analysis for use of this sort, and this is certainly a resource to us in the United States as we work on a system for regulators to evaluate these risks.
I see my time is about up, Madam Chair. I'll yield back.
Thank you very much. The gentleman from Texas, Mr. Gonzalez, is now recognized for 5 minutes.
Thank you, Madam Chair, and thank you, Secretary, for being here to testify before us. I have actually a follow-up to some of the issues that you just addressed. This devastating war in Ukraine and ensuing energy crisis in Europe have severely impacted economic productivity, echoing throughout the global economy. One of the ways to fight against this would be to expand exports of our LNG here in the U.S. However, the United States is at an effective export capacity, meaning additional pipeline infrastructure and export terminals would have to be built to expand the volume of LNG exports to our allies in Europe and around the world. The private sector faces challenges accessing capital to invest in these projects, due in part to regulatory landscape that we have today that keeps investors away. How does the FSOC's October 2021 report weigh this challenge and potential risk to the global financial system?
Well, you know, the issue that you're pointing to with the necessity of helping our European allies, particularly reduce their dependence on Russia for supply of natural gas. This is a critically important priority, and I know the Department of Energy and the White House are looking at what we need to do in the United States to facilitate that. I'm not an expert on the details about terminals, but would be glad to get back to you on that. This is not really, I would say, a financial stability risk that the FSOC has looked into or addressed in its report. It is certainly an important economic issue. With respect to the war in Ukraine, the Financial Stability Oversight Council and the staffs of the agencies involved meet on a regular basis to attempt to identify spillovers to the financial system that are of concern. Frankly, the financial system has functioned very well in the face of this unexpected shock. But the issue that you mentioned is very important.
Yes, it's a concern because today it's Europe and maybe another part of the world at some point in the future, and I think we should be prepared for something like that. Thank you, and I yield.
Yes, sure.
Thank you very much. The gentleman from Missouri, Mr. Lukemeyer, is now recognized for 5 minutes.
Thank you, Madam Chair. Good morning, Secretary Yellen. Secretary Yellen, Director Chopra of the CFPB is a member of FSOC, is he not? I say Director Chopra of the CFPB is a member of FSOC.
Yes, he is.
He has recently recommended removing deposit insurance from financial institutions as an enforcement action. During his proposal, Director Chopra specifically named financial institutions that have 27% of the U.S. deposits combined. And he proposed that these institutions should have harsher enforcement actions placed upon them, such as revoking their FDIC insurance or placing them into receivership. Do you agree with removing deposit insurance as an enforcement action against depository institutions?
You know, I'm sorry, I haven't had a chance to review his comments or proposals on this. I would say that deposit insurance plays a critical role in the banking system, and it's something that has promoted financial stability.
So from that comment, I would assume that you believe that deposit insurance is important to financial stability in the United States.
I agree with that.
Okay.
I'm not aware of not knowledgeable about the details of his proposal.
If you're concerned, if you believe that that FDIC insurance is a key factor in continuing to have stability in the banking area, especially when you have these big banks he's talking about, up to perhaps a quarter of all U.S. deposits not being insured, that would affect the stability of the economy. And you sit on FSOC, and he sits on FSOC, which their entity is for looking at financial stability risks, which you just stated a minute ago. Do you think Mr. Chopra is a worthwhile member to have on there and should have some actions taken against him for making a statement like that could endanger the stability of the financial markets?
Look, I'm not prepared to weigh in on his proposals. I don't know the details of it. I agree with you that deposit insurance is important, but it is not automatic that every institution is granted deposit insurance. That's something that the FDIC reviews how banks are operating and whether or not they deserve to have deposit insurance.
Madam Secretary, when you have a member of FSOC make that sort of inflammatory remark that could affect the stability of the financial markets by saying these institutions could have their FDIC insurance taken away from them, that sends shock waves from my position about what's going on. To me, it's unacceptable. If I was in your position as the head of FSOC, I would certainly have a little discussion with Mr. Chopra and say that you can't go out here and make those kind of wild accusations, and you can't have those kind of enforcement actions. That will destabilize the markets. But we'll write you a letter and hope you respond to that with regards to this situation, because I think it's paramount that the council be sure that they have members there who understand that the remarks could be inflammatory in a situation like this. So I thank you for that. Number two, second thing I've got. You know, on December 27th, 2020, Congress passed the Consolidated Appropriations Act of 2021, which funded the government and also included additional stimulus related to the pandemic, including another round of PPP loans. Title III of that section established the second round of a PPP, and that section 321, it was entitled Oversight. And it states, not later than the date that is 120 days after the date of enactment of this act, the Administrator and the Secretary of the Treasury, that's you, shall testify before the Committee on Small Business and Entrepreneurship in the Senate and the Committee on Small Business of the House of Representatives regarding implementation of this act and amendments made by this act. That means you were due, Madam Secretary, to appear before the Small Business Committee in the House 381 days ago and still have not shown up. I've sent you letters about this testimony in May of 2021, June of 2021, July of 2021, and March of 22, and still have not received a response. As someone who is the head of FSOC and someone who looks at the stability of our economy and someone who should be wanting to lend support and sort of stop some inflammatory discussions and actions and allay fears, your lack of being able to appear before us is very concerning. Do you have any plans whatsoever to appear before our committee, Madam Chair, the Small Business Committee?
I appreciate very much the role that Congress plays in oversight, and I come regularly to the Hill and to this committee to testify. In the situation you're referring to, Congress has expressly authorized me to delegate duties and powers of the Secretary to another officer or employee, and that includes the Deputy Secretary, and he has offered to testify multiple times in front of the Small Business Committee. I hope that you will agree to allow him to come and do so.
The gentleman from North Carolina. Gentlewoman from North Carolina. Ms. Adams is now recognized for 5 minutes.
Thank you, Madam Chair and Ranking Member for hosting the hearing today. Secretary Yellen, good to see you again. Thank you for being here. Madam Secretary, FSOC's annual report notes the significant increase in home prices between 2016 and 2019. That average annual increase was only 6%. But from March 2021 to March 2022, home prices rose 22%. So would you very briefly agree that the rapid increase in housing and rental costs presents a significant problem for those who are already home insecure? Would you agree to that?
Yes, I definitely agree. I think the supply of housing, particularly affordable housing in this country, is a huge problem. We've had low construction ever since, really since 2008, and I believe we have a huge shortage of affordable housing in this country. Of course, rising home prices and rental prices are an enormous issue.
Yes, ma'am. So in my district, Charlotte and Mecklenburg, private equity firms have been snapping up single-family homes and converting them to rental properties. Last week, the Charlotte Observer, our local paper of record, reported in their Security for Sale series that in North Carolina, institutional investors have purchased over 40,000 homes in the past decade. So the UNC Urban Institute reported over 10,000 of those are in Mecklenburg County, and that the average value of those properties are only 2/3 of the average single-family home. So that means that private equity firms are squeezing the less affluent out of home buying market, but depleting the supply. So, Madam Chair, I'd like to, without objection, to submit the articles that I mentioned for the record, including 2 others that touch on Charlotte's housing crisis from New York Times and Washington Post.
Without objection, such is the order.
Thank you. Secretary Yellen, can you describe why it might be dangerous for the housing market at large for private equity firms to purchase and convert homes at the lower end of the price spectrum?
Well, I would simply say that we have a shortage of housing, and it's critically important that we do everything in our power to increase the supply of housing. We have to use the tools that we have. The President's Build Back Better plan would have dedicated $150 billion to housing, including making major investments in public housing and home buyer assistance. But we certainly have to use all the tools that are available to us now to address the housing crisis.
Thank you. You know, we should have passed the President's Build Back Better agenda. It would have dedicated $150 billion to housing, including making major investments. And so I'm proud to have worked with Senator Leahy, Senator Collins, and Representative Rouser to introduce our bipartisan bicameral Lifeline Act, which would allow cities and states to use a lot of the fiscal relief funds to finance, to help with the housing development. So I encourage all of my colleagues sitting here today to co-sponsor the legislation. Madam Secretary, with the time we have left, would you tell me how important it is to maintain a robust supply of affordable housing during this time?
Well, I think it's critically important. We're seeing huge shortages in affordable housing, especially in high-priced areas of the country. And I think we need to do everything we can to address this shortage. I think that states and localities also have in place restrictions that make it zoning restrictions that make it difficult to build affordable housing. And so I think action at that level is also important. You mentioned fiscal relief funds, and we have certainly urged state and local governments to use these funds to expand affordable housing. It was an important issue in the pandemic.
Great. Well, thank you, Madam Secretary, for being here. Madam Chair, I yield back.
Thank you very much. The gentleman from Michigan, Mr. Huizinga, is now recognized for 5 minutes.
Thank you, Madam Chair. I wanted to call you Chair Yellen. You're still sort of Chair Yellen to me. That was how we first interacted for many years. But Secretary Yellen, just last month when you were here, we talked a little bit, and I know this is a little off topic from here, the FSOC, but we talked about Iranian sanctions, and there had been a report in the Washington Post about Iran demanding that they be taken off of some of the designations as foreign terrorist lists. You had said at the time that you quote, and I've got the transcript from that interaction right here, you were, quote, "I am not deeply involved in the detail of these negotiations." My question then also was, have you or anyone else at Treasury been directed to reduce Iranian sanctions enforcement so as not to interfere with those Vienna talks? You replied, "We haven't changed our sanctions on Iran." That wasn't my question. Have you been instructed to or requested to do anything? You said there's been no change in the administration policy to the best of your knowledge. What I'm really concerned about, I guess, is the Secretary of Treasury not being read in on those. You are the main, Treasury is the main source of sanctions. And is that still the case? Are you read in on these negotiations or not?
Treasury is regularly updated about the negotiations.
And you personally?
I have been periodically updated on this situation with the Iranian.
So then I guess I'll go back to my original question. Have you or anyone else at Treasury been instructed to back off on any of those sanctions vis-a-vis Treasury sanctions on Iran?
No, certainly not to my knowledge.
Okay. That's the kind of thing, though, that gets us, Madam Secretary, very nervous when you say not to my knowledge. So will you please go and investigate that? And I would like to find out so that we can have assurances that Treasury, with your knowledge or against your knowledge, hasn't been instructed by this White House to back off on those sanctions.
Nothing has changed with respect to Iranian sanctions.
Okay, I still request that. All right. Here's the other question I wanted to really get at. FSOC and its functions. talking about digital assets, recently the SEC released a staff accounting bulletin number 121 related to custody of digital assets for its platform users. Given FSOC's focus on digital assets, was there any coordination with other members of the agencies in those efforts from the SEC?
So I'm not deeply knowledgeable about this regulation. I need to look into it and get back to you.
I guess if you would, that would be extremely helpful. This is a sweet spot for this committee. SEC, in my opinion, should not be issuing one-off staff bulletins and guidance on digital assets instead of following the proper rulemaking process and coordinating with other agencies. So it seems to me, as chair of FSOC, that is a vital part as we are dealing with these digital assets. So I've got a minute and 40.
I mean, SEC and CFTC certainly have authorities, not comprehensive authorities over digital assets, but they certainly do have authorities and can act on their own within those
And I guess I'm wanting to know whether there's coordination within the agencies of FSOC. So we can continue that. In my last minute here, I want to talk a little bit about the effects of spending on the economy, and I know Ms. Wagner from Missouri was talking about that, and ironically, she's at a press conference right now dealing with the lack of baby formula and the inflationary prices and the supply chain there. So one economist has put it this way: spending plus easy money equals inflation. And that seems to be playing out. And I'm curious if you would prognosticate here a little bit, soft landing versus hard landing versus very hard landing. What is your expectations of what's going to be happening in the economy?
Well, inflation is a serious concern. Look, we're not the only country experiencing inflation.
But
Most
no other countries,
advanced countries
no other
are
countries
doing
at
so.
this level, though.
But it does show that there are factors beyond spending in the United States that are critical to inflation. We're seeing, because of the pandemic, supply chain problems develop.
And in my last
5
seconds, Jay Powell agreed with this. About 20% of inflation is due to energy, 20% labor, 20% supply chain, 40% due to monetary policy and spending. I yield back.
The gentleman from Pennsylvania, the gentlewoman, I'm sorry, from Pennsylvania, Ms. Dean, is now recognized for 5 minutes.
Good morning, Secretary Yellen. I am delighted that you're here again before us. Thank you, Madam Chair, for recognizing me. And I thank you for not minimizing the risks and the realities of inflation and what it means to all of our constituents. Clearly, the Fed has its work cut out for it and is stepping up to do just that. At the same time, I want to make sure we balance the conversation about the overall health of the economy. We can all beat the drum about inflation because it is painful, but let's talk about the underlying health of the economy following a pandemic and a global economic closure. Unemployment has fallen to 3.6%, down from a pandemic high of nearly 15% in April of 2020. If you compare that to 2008, the financial crisis, unemployment peaked at about 10% in 2009 and didn't fall to below 4% for nearly a decade. A decade. Secretary Yellen, can you speak to how different this recovery has been compared to the recovery from the financial crisis? How have the steps taken by Congress, including the American Rescue Plan, which you have spoken about several times today, and my constituents appreciate, how has the American Rescue Plan and some of the work that we have done here in Congress contributed to this extraordinary recovery?
So I appreciate your making this point. It's a critically important one. The American Rescue Plan deserves substantial credit for the fact that the unemployment rate is very low, that Americans have confidence in the job market. We're seeing the quit rate rise to levels we've never seen in the United States. And what that means is that individuals are seeing huge opportunities in the job market. They're receiving outside offers that let people move to better jobs and advance in the jobs that they have and see wage increases. The eviction rate in the United States is below pre-pandemic levels. We had a year last year in which child poverty dropped very substantially. Americans, on average, their household balance sheets are very strong. That's in part because of the support provided by the American Rescue Plan, and businesses are doing well, and while some built up debt during the pandemic, they're finding it possible to pay it down. So we have a good, strong labor market. I spent that decade following the financial crisis at the Fed, and I can tell you how concerned we were that using every tool at our disposal, it still took a decade to recover. And I can also tell you that when President Biden was elected, the projections as to where the economy might go were dire.
Exactly.
The CBO projected high unemployment. The American Rescue Plan addressed that. And the strong state of our labor market and of household balance sheets, this is the dog that hasn't barked in the night, that we should, that's the credit that goes to the American Rescue Plan. Of course, we have to address inflation.
I thank you for your legacy of dealing with these issues and recognizing what the American Rescue Plan has done. I had a father thank me for the American Rescue Plan because he and his wife have 2 little children, and what it did in terms of the child tax credit was meaningful to them. Sadly, not a single Republican could bring him or herself to vote for the American Rescue Plan. And sadly, while we made a big difference on child poverty and hunger by not renewing the increased child tax credit, of course, we send those families back into poverty. Just quickly, in the time I have left, when you were last here, you talked about the Russian economy reeling as a result of the sanctions. Can you give us an update?
Well, it's absolutely reeling. By their own estimation, the Russian economy looks set to contract at least 10% or more this year. Inflation is expected to reach double-digit levels, perhaps 20%. And there is an enormous, because of our sanctions, shortage of goods and services that Russia needs to replenish the munitions that it's using in the war. Its high technology and defense industries will be damaged for decades to come.
I yield back, and I thank you.
The gentleman from Kentucky, Mr. Barr, is now recognized for 5 minutes.
Thank you. Madam Secretary, I want to focus on your 2021 report on climate-related financial risk. I have expressed in this committee before that it is implausible, if not far-fetched, to suggest that climate change, a phenomenon that occurs over decades, could somehow suddenly overwhelm the banking system, insurance sector, or reinsurance sector. What evidence has FSOC found that banks, lenders, or insurers have ever mispriced weather risks so substantially that it would result in systemic risk?
Well, it's not just a matter of weather risks, which are clearly rising in severity and could have a significant impact on banking organizations, but there are also so-called transition risks that...
Right, so regulatory risks that the government could redirect capital away from fossil energy and increase inflation. Is that what you're referring to, transition risks?
It's an existential threat with respect to climate change of leaving our children and grandchildren with a planet that is all but uninhabitable.
Well, let's drill down on that. Let's drill down on that, reclaiming my time. In FSOC's report on climate-related financial risk, did FSOC consider the risk of overinvestment in novel, unproven, and highly risky speculative green assets and the risk of diverting investment away from stable, proven, and low-risk brown assets?
The FSOC and individual regulators are not telling banks what they should or should
Well,
not do.
I think
with
FSOC,
respect to their
FSOC should
investments.
consider overinvestment in risky assets. If in FSOC's consideration of climate-related financial risk, did FSOC consider the substantial risk that has actually now materialized, that overregulation of the fossil energy sector, ending Keystone, blocking lease sales on federal lands, constraining supply of energy, has actually undermined financial stability, specifically historic inflation and $4.37 a gallon gas?
I think we owe that to the failure of our domestic industry to ramp up production to pre.
I don't think that's what they say. I think they say they can't
levels.
get approval, and when they can't ship through the Keystone Pipeline, and when they can't access capital because of ESG disclosure mandates, that's why we have a shortage of energy. Did FSOC consider that the SEC's ESG disclosure proposal designed to redirect capital away from fossil energy will increase the cost of energy, creating a greater risk to economic stability?
Look, investors with over $100 trillion worth of assets have said that in order to properly evaluate investments, they need disclosures about the risks that individual firms have with respect to climate. And regulators all around the world are acting
I understand
to
that, but
provide that
Will you
information.
commit to engaging Chairman Gensler in FSOC to assess the risks to our energy markets and exacerbating the inflation crisis posed by politicizing the allocation of capital through ESG regulation? And will the FSOC consider the risk of steering investors toward green or ESG firms that could make them riskier, not safer, by inflating their asset values?
Well, look, I think you should note that the largest banks in the United States and around the world voluntarily joined an alliance this past year to commit to
I know what they
forming
did.
their portfolios.
I'm asking you about financial risk. I'm asking you, Madam Secretary, I'm asking you about your job as chair of the FSOC to evaluate all financial risks. And I want to know whether you acknowledge that stocks in many ESG stocks in many ESG-related ETFs and investments trade at elevated price-to-earnings ratios and multiples because investment returns are sacrificed for non-pecuniary factors. Are you evaluating that risk to the financial system because returns are sacrificed?
We do look at asset valuations and recognize that significant shifts in them can be a risk to financial stability.
Finally, will you commit to never, as long as you are the Treasury Secretary and Chair of FSOC, to allow a single minute of time during any meeting of FSOC be devoted to the topic of abortion?
Abortion is not a topic that
Thank you.
FSOC has looked at or that
I think the fact that there's a focus away from actual financial stability risks and towards things like abortion and meteorology means that we have our eye off the ball in FSOC. I yield back.
FSOC has nothing to do with abortion.
The gentlewoman from Michigan, Ms. Tlaib, is now recognized for 5 minutes.
Thank you for being here, Madam Secretary. I want to talk about something that's really important to my district, but I want to start with a few questions. In defining financial stability risks from climate crisis, do you think we should be defining the risk as only government policy change that would happen only with, potentially that's the only way that would create disruption? Do you think the government policy is the only form of transition risk regarding climate crisis?
The underlying risk is that we have a process of climate change taking place which threatens the viability of life on Earth and poses enormous risks to our children and our grandchildren. And eventually, I believe this risk is becoming clearer from what all of us see happening around us every day. And if that isn't the case for some people, it will become clear in the decades ahead. And there will be
I know.
adjustments and they can contribute.
I'm with
to-
you, and this is why I'm asking. You know, in defining financial stability risks from climate crisis, you know, during the Senate confirmation for the Federal Reserve Chair, Powell, he defined it, transition risk, as government policy change that happens, which could potentially create disruption. But what about rapid changes in technology or major shifts in, you know, consumer consumption? I mean, right now, are we considering the supply chain impact due to rising sea levels or other climate-related effects?
Well, I would agree with your statement that these risks do not have to relate to government regulation. They could certainly relate to technological changes.
I'm so glad you're
or
saying that.
rapid shifts in consumer preferences.
Great.
There are other sources.
It's a huge economic risk, and we really need to be looking at it. So G20 financial institutions currently have nearly 22 trillion of exposure to carbon-intensive sectors. And last year, the world's largest financial institutions, Madam Secretary, pumped $742 billion into the fossil fuel industry. Secretary, we actually saw more fossil fuel financing last year than we did in 2015, the year the Paris Agreement was signed. We're going in the wrong direction. So as the world's largest financial institutions continue to grow their positions in carbon-intensive market, you know, will this make our global transition from fossil fuels to clean energy slower and more dangerous to our economy?
Well, I guess what I see is that the world's largest institutions recognize the importance of shifting their lending in ways that will help us, the globe, the U.S. and other countries, achieve net zero by 2050, and are voluntarily making
They're
the
saying it,
changes.
but they're not doing it, Secretary.
Well, I think it's important for groups to monitor those financial institutions and see that they...
I really think we need to. You know, FSOC's report on risks posed by climate change last year, the Council outlined several recommendations as first steps in addressing the climate crisis, including increased scenario analysis, climate risk disclosures, and I applaud their report. I think their recommendations were very clear. However, I'm really perplexed because as you're talking about, many of these financial institutions that are financing fossil fuel projects have continued to say this thing about net zero, public comments, and pledge to align with the Paris Agreement, but they're not. I mean, they're completely contradictory. Secretary Yellen, I mean, I've said, you saw the record flooding, everything. How will better risk modeling and climate disclosures change the behavior of these financial institutions?
It will allow their supervisors to form a clearer view of the risks that these institutions are taking and then ensure that they're managing them properly, and it will help the institutions themselves better appreciate the risks that they're undertaking. They're probably not doing that kind of analysis now, and we want to promote that understanding.
Yeah, and it's just to be clear, I mean, I'm for that, but I think the result needs to be actual, you know, the reduction, and to really look at this in a very clear way. I don't think we're in line with what I think, you know, Chairman Powell is talking about, and the fact that a lot of other countries are looking at this as a risk very clearly, an economic risk, I think is something very telling. Thank you, Madam Chair. Thank you.
The gentleman from Texas, Mr. Williams, is now recognized for 5 minutes.
Thank you, Madam Chairman. Madam Secretary, thank you for being here. I am a small business owner back in Texas, not was, but am. And I meet with families, businesses, ranchers, car dealers in my district all the time, and inflation is one of the first things they bring up. And yesterday's CPI data showed this phenomena is not slowing down. Now, year over year, gasoline's up 43%. You know these numbers. Electricity up 11%, meats, fish, and eggs up 14%, and even used cars are up 22%. You were one of the top voices in the administration claiming inflation was transitory. Well, that's obviously proved to be extremely wrong. And yesterday, the Wall Street editorial board chided the president for lying to the American people and blaming everything except for his own party's policies as a contributing factor to these price increases. So just a simple question, keep it short, very simple. Will you admit that government spending is a contributing factor to inflation?
There are many factors that are responsible for inflation. You can see inflation at unacceptable levels in all advanced countries around
I
the
know,
world.
we've talked about, but not to get my time back, but we're just saying government spending is a big cause for it, isn't it?
Well, we supported spending, it contributed to demand, and it had a very favorable effect
All right.
on most Americans' well-being. We do have to deal with inflation.
All right. The energy sector is an important energy industry in my home state of Texas, and I keep hearing from this administration, that it is the private sector's fault that they're not producing more and haven't invested in any new capabilities to expand production. And quite frankly, that's an insult. Now, this is such a ridiculous excuse to once again deflect blame away from their own misguided policy decisions that are having a material impact on American lives. It's just deflect all the time. As a business owner, as a current business owner, certainty is key before you deploy capital. Since President Biden's first day in office, he made it abundantly clear he's going to be hostile towards this energy industry. And a few of these actions are immediately canceling the Keystone Pipeline permit when he came into office and instituting a leasing moratorium for onshore and offshore energy production while threatening to raise royalty rates, and pushing his climate agenda through financial regulators to make people think twice before providing financing. Just this morning, the Interior Department canceled a 1 million acre oil and gas lease in Alaska that could have brought some relief to the American people when we're sky high in gas prices. So, Madam Secretary, why would any domestic energy company want to invest in new production capabilities when all this administration does is project uncertainty? They want to raise taxes, they want to raise regulations, and they're just frankly hostile, just mean and hostile towards this industry. Why would anybody want to come here?
Well, I think when the pandemic struck and gas prices fell, a lot of oil companies and energy companies in the United States suffered hard times and losses, and it was natural for them to diminish production and reduce investments in drilling. They probably didn't expect such a rapid recovery as we saw from the pandemic, and as demand increased, it drove oil prices up. I think this gives a good deal of impetus to domestic energy companies to raise production in the short term. Over the longer term, climate change remains critical. And I think what we've seen happen with energy prices rising because of Russia's invasion of Ukraine, it tells us that we need to move to renewable energy sources where our supplies and well-being and prices aren't so vulnerable.
I might have a better idea. Maybe incentivize the private sector and let the private sector compete and help drive prices down. The government never gets that done. The government creates the problems that we're in today. So I would say you might want to try incentivizing these people. So in closing, as a result of foreign tax credit regulations finalized by Treasury late last year, income and withholding taxes that have been credible for decades are no longer eligible for a foreign tax credit. So this could have effect, again, of incentivizing U.S.-based companies to move more of their operations overseas. So quickly, are you willing to reopen this rulemaking to ensure that American businesses are not being put at a competitive disadvantage so they don't leave and cost us more jobs? Because this is America, the greatest country in the world. Would you be willing to do that?
I'm sorry, what rulemaking are you referring to?
Well, okay, my time is up. Thank you.
Thank you. The gentleman from Illinois, Mr. Garcia, is now recognized for 5 minutes. Mr. Garcia, are you unmuted? We'll wait for Mr. Garcia. Meanwhile, the gentlewoman from Texas, Ms. Garcia, who is also the vice chair of the Subcommittee on Diversity and Inclusion, is now recognized for 5 minutes.
Thank you, Chairwoman Waters, and thank you, Secretary Yellen, for joining us again today with this important annual report. First, I would like to applaud you, Madam Secretary, for the Treasury's handling of the financial stresses we've experienced recently. COVID-19 has caused much social and financial hardships to our community. Putin's brutal and unprovoked invasion of Ukraine has only exacerbated these problems. I commend Treasury's implementation of historic multilateral sanctions against Russia, punishing them economically and isolating them politically. You, this Congress, and the President have constructed a broad and effective international coalition. We hear good news of others that may be joining. Now we must continue this effort to maintain and expand help to Ukraine and turn up the pressure on Putin. Congress's oversight through this Financial Stability Oversight Council is really, really important. This stability allows Americans to trust their hard-earned paychecks and will be safe from predatory bad actors. I want to focus today on a couple of things that have perhaps been talked about. And just to be clear, government spending is not the only factor in inflation, is it not?
There is supply chain bottlenecks. Look at what's happening in China, the lockdowns that they're using to handle the pandemic are disrupting supplies to our economy. The war in Ukraine that Russia has launched is impacting food prices. We've seen more than a doubling of wheat prices. Not only is that impacting American food prices, it's threatening starvation in many parts of the world where there's already food insecurity. It's affecting energy. None of this has anything to do with government spending.
Right. In fact, the food shortage may cause a bigger crisis than even the gas shortage, I understand.
The food crisis is terribly worrisome. With respect to wheat, both Russia and Ukraine are tremendously important sources of exports, the breadbaskets of the world. And, you know, at the moment, Ukraine is really unable to ship wheat out of the country. That's part of why wheat prices have risen so much. There have also been droughts in many parts of the world, and we're terribly concerned and are very focused on rising food prices, the impact that will have in many parts of the world, including Africa.
Right. And so I want to focus on a couple of things that have already been said, but just to probe a little more. In response to the question from one of my colleagues, you mentioned the decrease in child poverty as a result of the child tax credit and some of the steps that Congress has taken to help the average working family. Do you know exactly what percent of reduction has resulted from all the investment in the child tax credit?
You know, I don't have the exact figure, but I do know it was a substantial reduction in child poverty.
I thought I heard 40%. Was that?
That's the type of number I have in mind, but I can get back to you. It was a very substantial impact.
Right, and I know that you received a letter from some Texas Democrats asking your Inspector General to look at what our governor is doing with perhaps misuse of some of the...
This meeting number is not valid, or the meeting has not yet started. Enter the meeting number followed by pound.
Madam Chair, I pause. Can I get some of my seconds back? But we sent CARES packages. We sent COVID dollars. We sent the dollars that we sent them to recover for their loss of revenues during the pandemic. And there's concern that some states did not use the dollars as Congress intended. In fact, a Washington Post article recently, I think it was last week or yesterday, said that from refurbishing prisons to constructing new golf courses, one state, Arizona, even used the money to discourage schools from requiring students to wear masks, prompting Treasury Department to threaten to claw back the aid. What are we doing to claw back the aid? I know we sent a letter, several members from Texas, concerned about our governor using those dollars for what he calls Operation Lone Star, which is his attempt to control the border.
We have clear guidelines in place about permitted uses of that money and not permitted uses, and we are monitoring and have a reporting system that will let us review how states and localities are using that money, and promise you that if the funds are used in ways that are inappropriate, we will claw it back.
You will claw back. And how much time do you think that would take? I mean, I know what our governor's doing. I didn't realize till this article that this was happening in many other states.
The gentlewoman's time has expired.
Madam Chair, before you leave me, can I submit for the record, I ask for unanimous consent, the article, Texas Democrats urge review of use of COVID aid to fund border crackdown. Washington Post.
Without objection, such is the order. Thank you. The gentleman from Arkansas, Mr. Hill, is now recognized for 5 minutes.
Thank you, Chair Waters, and Madam Secretary, it's so great to have you back before the committee, and thanks for being responsive to our questions, and thanks for the incredibly challenging times you're in trying to guide our financial response to the Ukraine's tragedy of being invaded by Putin. So I want to start there quickly because I was looking back at the FSOC meetings. I'm actually going to talk about FSOC. Has met 9 times since you've been confirmed at the Treasury. And only in 2 of those meetings did you talk about cyber concerns to our financial institutions. And one of those was just because of the invasion. And of course, we've been briefed up here on the cyber risk potentially posed by Russia. In contrast, the FSOC spent a lot of time on climate. And so my question to you is, do you think that cybersecurity incidents due to the Russia conflict are a risk to the financial system here in the U.S.?
Cybersecurity is one of the key threats to the financial sector, and FSOC has consistently identified it, including in this report, as a serious concern. The Treasury is also has responsibilities in this regard and is very focused on, especially with the Russia-Ukraine situation. We're working very closely with financial institutions to make sure that they have the information.
This meeting number is not valid, or the meeting has not yet started. Enter the meeting number followed by pound.
I tell you, those robocalls are a real problem in our political.
Sorry for the interruption. We'll make up for the time. Go right ahead.
No, thank you, Madam Secretary. So let me stop you there just for a second and say, since you, in those 9 FSOC meetings, you talked in 7 of them about climate change and only 2 in cyber, would you say that at this time in war, global war with Ukraine?
We have an ongoing and robust program to deal with cybersecurity and have long recognized it as a critical threat. Climate change is something new that the Council has not previously addressed, and the reason we have discussed it in so many meetings is because it's a new initiative, it's a complicated one, it's one that requires agencies to work together, and it's a substantial long-term threat. Both things are important. One is not more important than the other.
But you would say that cyber resiliency right now is a much more critical concern to the financial sector than long-term talking and planning and thinking about climate change, yes or no?
Climate change is a substantial long-term threat, and cybersecurity is a long and a short-term threat we are very focused on.
Let me change subjects and talk about the reverse repurchase market that your former organization, the Federal Reserve, runs. Over the last couple of years, we have about $1.9 trillion in an overnight repurchase agreement that's showing just how much liquidity is out in our system that's not being able to be used. It can't be used for productive lending purposes, so the banks have effectively too much stimulus from fiscal contributions to the economy, as well as the laxity of our monetary policy recently. Do you think that reverse repurchase agreement balance is a challenge to financial stability as we go through a tightening phase at the Federal Reserve?
Well, I really don't want to comment on issues that are in the domain of the Fed. It's the Fed's program, and I'm going to refrain from commenting on it. But I will say that FSOC is concerned about the functioning of the Treasury market. We have had episodes in which liquidity has dried up, and we're working very hard coordinating with the Interagency Treasury Working Group to look at reforms to make sure this critically important market for the United States and the globe functions well, has the liquidity that it needs.
Good. Well, I would invite you to look very closely at what Gary Gensler has said about the primary dealer market and urge him to be very cautious about injecting any uncertainty in our primary Treasury dealers at this time of, tough conditions as we tighten and want to maintain that liquidity. Thank you, Madam Chair, and I yield back.
Thank you very much. The gentleman from Massachusetts, Mr. Auchincloss, who is also the vice chair of the full committee, is now recognized for 5 minutes.
Thank you, Madam Chair. Madam Secretary, welcome. I'd like to discuss in these 5 minutes what more the United States Treasury can do to defeat Russia in Ukraine. The central bank sanctions crafted by you and Deputy Secretary Adeyomo have been the brass knuckles of NATO's 1-2 punch of sanctions on Russia plus support for Ukraine. They were unexpected, they hurt bad, and you and the Deputy Secretary deserve a lot of credit for crafting those.
Thank you.
I am concerned, though, that Russia's continued exportation of almost 8 million barrels per day of oil continues to fund their barbaric war machine. The United States and Canada, as you obviously know, have barred Russian oil. The European Union is trying to, but Hungary is exercising a veto on that effort. So first, what carrots and sticks do we have to compel Hungary to support an EU blockade of Russian oil?
Well, we're working very closely with our European allies. I'm actually traveling to Europe next week, and we'll have discussions with them. Most of them were in Washington.
With Hungary in particular, though.
With Hungary. I've not had conversations with Hungary. My NSC colleagues may. The European Union, the European Commission is working with all of its members to...
All of the members agree except for Hungary. This is a monumental step, and I would encourage you and the administration to do your utmost to use carrots and sticks with Hungary to get them on board here with the European Union's approach. And that is because if the EU does blockade Russian oil, this could force Russia to redirect up to 5 million barrels out of their 8 million total every day. And they can't. It seems very unlikely that they could actually redirect that 5 million barrels per day going to Europe. Only China and India have enough demand to even take it, and neither seem willing to concentrate their supplier risk to that degree, especially with the potential of secondary sanctions. And furthermore, there's not even the pipeline or the shipping capacity really to redirect that full 5 million, even if there were demand from China or India. In short, what that means to me is that if and when Europe does join our blockade, and again, I encourage you to do everything you can to get Hungary and the EU on board, the West is going to have a tremendous amount of leverage over Russian oil production, more than I think we appreciate right now. Keeping 5 million barrels a day in the ground in Russia is going to be devastating to its oil production industry. They can't do it. They can't do it for their upstream services. They can't do it for maintaining their oil fields. Have you examined any potential effort with our NATO allies to take advantage of that leverage that we would have?
We've had many, many discussions with them about energy and Russian oil. Let me just say, our objective since day one has been to have as large a negative impact as we possibly can on Russia, while to the best of our ability protecting the rest of the world. And when it comes to oil and energy and shutting it in, we do have to remember that shutting in that Russian oil is likely to boost global energy prices, which can have a very damaging effect and is in the rest of the world, and also can counterintuitively perhaps raise Russia's revenue in spite of the fact that it's producing less oil.
To that point,
at the
Secretary,
same time we're working with them, we're also considering possible things we could do that would lower Russia's oil revenues while protecting the rest of us.
And I think we may be thinking of the same lines of effort here, but would those other things that you could do include a special payments authority where we could be, with our NATO allies, actually purchasing Russian oil, but only remitting to Russia the cost of production, 20 to 25 dollars per barrel, but taking the excess, which would normally go to the Kremlin as taxes, and instead directing that towards Ukrainian reparations. This has been proposed by experts. I'm sure you're looking at it. And would you be willing, and your Deputy Secretary maybe in particular, be willing to engage with me on what that might look like and to what degree you've been planning for it?
We would be glad to engage with you on that, and that is the kind of alternative that we have been examining and discussing with our allies.
I appreciate that. In the final 20 seconds, Secretary, have we explored sanctions on oil field services providers who enable Russian oil production upstream of their actual of the actual distribution of that oil? Those companies have escaped sanctions, and they provide much-needed technical expertise that Russia has not developed organically.
Well, you know, the withdrawal of foreign oil companies from Russia is really hurting their ability to extract oil now and in the future. And we've put in place some sanctions.
Madam Secretary, the gentleman's time has expired. You may submit your question for the record. Madam Secretary, welcome again, and thank you for your many years of public service. The gentleman from Minnesota, Mr. Emmer, is now recognized for 5 minutes.
Thank you, Mr. Chair, and thanks to you, Madam Secretary, for joining the committee today. The Democrat-created Financial Stability Oversight Council, or better known as the FSOC, as you've been referring to, has found itself in a unique regulatory position recently. Secretary Yellen, as the chair of the FSOC, you know better than anyone that the FSOC operates independently and is not directed by an administration to make and implement policy decisions. Historically, Madam Secretary, does the FSOC take direction from the White House on activities and institutions which to investigate and, if appropriate, designate those activities or institutions as systemic risks?
The FSOC, as you said, is a group of independent regulators.
My question is a yes or a no. Does the FSOC take direction from the White House?
No, it does not.
Thank you. That's what I thought. The FSOC exists to independently identify emerging threats to our financial stability and align regulatory frameworks around those risks. Secretary Yellen, by executive order, you convened the President's Working Group on Financial Markets in July of 2021, and you played a key role in the delivery of its November 2021 stablecoin report. The report recommends that Congress enact legislation to limit stablecoin issuance to insured depository institutions, banks. For the record, this is a recommendation that does not have consensus in Congress, not even amongst committee Democrats. The report also states that in the absence of urgent congressional action to enact this legislative recommendation, the FSOC should step in to designate various stablecoin activities as systemic risks, which would jumpstart administration-wide regulatory rulemaking. Secretary Yellen, has the FSOC officially designated digital asset or stablecoin activities as systemic risks?
No, it has not done so.
Thank you. Thank you. Digital asset and stablecoin activities have not been officially designated as systemic risks from the FSOC. Do you believe the FSOC should take action if Congress does not urgently enact comprehensive crypto legislation?
We would very much like to see Congress adopt a coherent
I'll ask it again.
I'm asking
you who convenes the FSOC, do you believe that the FSOC should take action if Congress does not urgently enact comprehensive crypto legislation?
It's something that I think FSOC should look at and
So the answer is yes?
I don't know that it's appropriate, but it's something that bears examination.
Thank you. You previously explained to us that the FSOC operates independently and does not take direction from the White House on labeling systemic risks. However, it seems pretty clear that absent urgent action by Congress, the FSOC, under your leadership, is prepared, perhaps, even though you said maybe not appropriate in your words, is prepared to designate certain stablecoin activities as systemically risky in response to the White House's digital asset agenda. Now, as everyone in this room is aware, Madam Secretary, legislating takes time. And there's nothing more dangerous to innovation and opportunity than when the federal government rushes to legislate or regulate, for that matter. The Biden administration knows this as well as any of us. But the President's working group and the President Biden's crypto executive order still threaten to ignite the FSOC if Congress doesn't do what the Biden administration requests. Put simply, Madam Secretary, the administration intends to weaponize the FSOC to circumvent Congress and the American people on digital asset policy. This recent history of activity demonstrates to me that the FSOC is no longer independent of partisan pressures and should be brought under control, under congressional appropriations supervision, so elected officials can make sure the voices of the voters are represented in the decisions of the FSOC. And for that reason, I introduced the FSOC Reform Act, which brings the FSOC under congressional oversight and increases the transparency of the council. The future of crypto, Web3, and the ownership economy cannot and must not be dictated by any entity that is supposed to be independent, but instead takes its cues from a political agenda. Thank you, and I yield my time, the balance of my time.
The gentleman yields. The chair now recognizes the gentleman from Illinois, Mr. Garcia, for 5 minutes.
Thank you, Mr. Chairman. Made it in a nick of time. Good afternoon, Secretary Yellen. Thank you for being here. And thank you, Mr. Chair, for hosting this important hearing. Secretary Yellen, you were chair of the Federal Reserve in 2016 when FSOC finalized a study examining state and federal banking laws that could have a negative effect on the safety and the soundness of the financial system. One of the recommendations that the Federal Reserve made in that report was to close a loophole known as the Industrial Loan Company, or ILC, loophole. The ILC loophole allows commercial companies to operate banks that are not regulated like banks, and it has caused financial stability problems in the past. As the Fed wrote in that report to FSOC, quote, "It must also be noted that the companies that failed or required assistance at the outset of the 2008 financial crisis included a number of companies that owned and controlled ILCs," end quote. So, Secretary Yellen, my question is this. In light of the financial stability risks that we are discussing today, including digital assets, shadow banks, and big tech entering the financial services space, do you still agree with the past recommendation by the Fed to close the ILC loophole?
So this is an issue I haven't looked at recently, but I have no reason to think that my view would change on this. The Fed felt at the time that report was written that there are great dangers in connection with ILCs, but long been opposed to mixing banking and commerce for reasons I think, if anything, are probably stronger now rather than weaker than they were then. And I continue to believe that it's likely to be appropriate.
Thank you, Secretary. And as I mentioned before, the ILC loophole allows commercial and technology firms like Amazon, Facebook, and Walmart to acquire a full-service FDIC-insured bank. So can you share why it's important to maintain that separation of banking and commerce principle? And please describe what systemic risks can come from allowing non-financial companies, such as tech companies, to enter the banking services space.
So there are a number of reasons why this seems to be dangerous. One reason that the Fed always worried about is that when a commercial company owns a bank, that credit decisions can be influenced by issues other than banking and safety and soundness considerations because of incentives that come from the other part of the business, the commercial part of the business. In addition, this tends to diminish competition and to promote monopoly and market power, and that's probably more important than it ever was before. And if sufficiently large commercial company were to become dominant in the payment system, I think there could certainly be financial stability risks.
Thank you for that, Secretary. Another question. I introduced the Bank Merger Review Modernization Act of 2021 to ensure bank mergers are in the public interest by clarifying and strengthening the public interest aspect of the merger review and require regulators to use a quantifiable metric to evaluate systemic risk. Do you support that bill?
I'd be glad to take a look at the details and work with you on it. I think that's an important area.
Okay, thank you. And are there other reforms that Congress can enact into law that would promote competition and financial stability in consideration of bank mergers?
I will have a look at it. I certainly believe it's important to have competition in banking and appropriate regulation there.
And if I could just switch gears very quickly, my time is running out. Today, FSOC can only make non-binding recommendations to financial regulators to take actions to address systemically risky activities. The Systemic Risk Mitigation Act, which I have previously introduced, would give FSOC rulemaking authority to better address systemically risky activities. Would you support giving FSOC that authority?
It's an area that I think is certainly worth looking at, and I'd like to have the opportunity to work with you on that.
Thank you, Secretary. I yield back to the
Time has expired. The chair now recognizes the gentleman, Mr. Loudermilk, for 5 minutes.
Well, thank you, Mr. Chair. Secretary Yellen, welcome. Thank you for being here. I want to start off a little bit on some of the issues that Mr. Hill started off with, talking about cybersecurity. Personally, I was alarmed to see the FDIC Chief Innovation Officer's resignation in February. He had lamented that the FDIC has outdated technology and has a tendency to resist change. I believe that type of culture will not help the financial regulatory agencies stay ahead of cyber threats. And as someone who spent most of his work in the private industry in the IT business, I know how significant these threats are. Do you feel that the FSOC member agencies are open to innovation? And if so, what are you doing to foster that relationship or that willingness to bring in new technologies, especially for cybersecurity?
So I absolutely believe that innovation is important. It's a benefit to the U.S. economy, and in the long run, it's probably the most significant source of growth and well-being. So we should want to promote innovation, but we need to have an appropriate regulatory framework so the innovations that are produced produce net benefits to society, and we make sure that they don't cause harms.
Well, thank you. And I see a lot of resistance to innovation, not only in regulatory agencies, but even within Congress. And so the only way that you're going to stay secure is to stay ahead of the bad guy. And the bad guy is continually innovating and bringing in new technologies. And if we lag behind, we put the entire financial system at risk. We put every American citizen that participates in our financial system at risk. So I highly encourage you to look at innovation as a friend, not as a foe. But quite often regulatory agencies take the other approach. Another topic, in your confirmation hearing last year, you said that designating non-bank companies as systemically important may not be the right approach to addressing risks in the financial system, and that activities-based approach would be more appropriate. And I appreciate that. Do you still stand by those comments you made to the Senate?
So let me clarify. There are two different tools, designation and activities-based approach. And I believe in different circumstances, each can be appropriate. It shouldn't be one or the other. Now, designation was meant for non-bank financial companies whose material distress or whose failure would cause material risk to the financial system. We are focused on non-bank, the FSOC is focused right now on non-bank financial risks coming from money market funds, from open-end mutual funds, and from hedge funds. But the approach that we think is appropriate is not designation, it is an activities-based approach.
Well,
and,
thank you.
And so certainly that's an appropriate approach. I wouldn't say, though, there could be circumstances in the future where designation is the right tool.
I don't mean to cut you off, but I am running short on time, and I have a couple other questions. Unfortunately, one of the bills included for discussion in this hearing ignores the very statement that you had made to the Senate. In 2018, when a strong bipartisan group of lawmakers reformed Dodd-Frank, we recognized that designating companies as systemically risk-based on an arbitrary threshold is unworkable. So I hope my colleagues will remember those lessons. Moving on to another topic, one that Mr. Emmer touched on a little bit, is the President's Working Group on Financial Markets and his recommendation that Congress pass legislation to apply a bank regulatory regime to stablecoins. As everyone understands, the stablecoins are primarily used for trading crypto and payments, and there are many significant differences between stablecoin issuers and banks. For example, stablecoins are not used for lending, so it would not make sense to apply lending laws and regulations to stablecoins. Do you agree that it would not make sense to apply the full banking regulatory regime to stablecoins, and that a more nuanced approach would be appropriate should you do as Mr. Emmer indicated and regulate
The
this?
gentleman's time, excuse me, Madam Chair.
Differences.
The gentleman's time has expired. I'm going to ask that he submit the question for the record. We have many members who are waiting, and we will now move on to the gentleman from California, Mr. Sherman, who is the chair of the Subcommittee on Investor Protection, Entrepreneurship, and Capital Markets. You're now recognized for 5 minutes.
Some of my Republican colleagues seem to believe we should be in an economic nirvana, that COVID killed 1 million Americans, of course. It's no laughing matter, and it would have killed millions more if we hadn't taken action. So they somehow believe that there was some way that we were going to get through COVID without any economic dislocation, and that the American Rescue Plan was a giant mistake. So just for the record, wouldn't we have had millions more Americans in poverty, hunger, evictions, homelessness, and foreclosures had we not passed the American Rescue Plan?
Absolutely. We can thank the American Rescue Plan for the strong labor market we have now and the strong financial position of most households.
The greatest pandemic in history and economic nirvana have not gone together coincidentally in any country in the world. There was no perfect way to get through this. I want to thank you, Secretary Yellen, for all the help that Treasury provided in creating the Adjustable Interest Rate LIBOR Act. Congress, much out of character perhaps, solved the problem 1.5 years before the LIBOR hit the fan. It is now up to the Fed to write the regulations, and I hope you can inspire them to do so expeditiously, because you have testified that the whole LIBOR issue is one of systemic risk. I see you nodding, so I assume you'll be doing that.
Well, appreciate the Congress passing that law. I think it's very helpful in dealing with legacy contracts.
Some of my colleagues have put forward the idea that gas prices are entirely a matter of U.S. oil production, and that somehow a speech saying that we've got to move to a carbon-free future leads to higher prices in one country, the United States. In fact, and they somehow say that the Biden administration has constrained oil production, and if it wasn't for low oil production, we'd have low gas prices. Here are the facts. In 2021, America produced more oil than we did in 2020, the last year of the Trump administration. And next year, we're going to produce more oil than we ever had in history. Unfortunately, oil is a worldwide commodity, and while we will produce more oil next year than at any time in history, we will not have the lowest oil prices at any time in history. If you open the dictionary to oxymoron, they'll say, see stablecoin. Coin says it's stable, not stable. We have seen Terra drop from $18 billion of investment down to, I think, a value today of about $1 billion, maybe a bit less. It is not terra firma, it is terra incognita. Tether is much larger. Tether has an $83 billion cap. It's claims to be tied to the dollar. But I'm told that they have not issued any audited financial statements, although they keep promising them. So I have no idea whether their statements of what reserves they have are accurate or not. But they apparently have invested substantially in Chinese commercial paper, which may or may not have value at various times. And they've invested in cryptocurrencies, which have lost over half their value in just the last few months. This does not look like my father's money market fund or my grandfather's bank. So their assets don't appear to be very liquid. What are the implications for our economy if Tether, which just broke the buck, goes all the way to terra incognita?
Well, I think you've just illustrated, and we've just had over this last week with Terra and with Tether, an illustration of the risks associated with stable coins, that there can be runs, and we've seen this historically with private monies, and we invented a good regulatory framework, I think, for dealing with this.
I'm going to try to
Insured
sneak in
Depository Institutions.
one more concept. Through our tax system, we provide tens of billions of dollars of subsidies for those who have pensions and 401ks. We do so that they'll have a stable retirement and invest their money in operating companies that provide jobs. I would say
The gentleman's
allowing
time has expired. We'll ask you to submit your question
investments in
to the Secretary for the
cryptocurrencies do
record.
neither.
The chair will have to now recognize the gentleman from Ohio, Mr. Davidson, for 5 minutes.
Thank you, Chairman. Madam Secretary, thank you for your time here today. I wish we all had a little more of it. But, you know, yesterday when you were at the Senate Banking Committee, you stated that student loan forgiveness could be good for the economy and that you will, quote, support anything that President Biden decides as a part of his policy on the issue. Do you really believe that?
I'm sorry, on what issue?
Student loan forgiveness. Whatever Joe Biden says, you're good with?
I believe all I've said on student loans is that they can be extremely burdensome and make it difficult for individuals to begin to buy a house or to save for retirement.
Of course, all debt has that effect. The principle of compounding interest should be taught earlier and often. And as a consequence of the federal takeover of the student loan industry, we're looking at, according to the Department of Education's estimates, over $400 billion at risk of default because students can't repay them. There are complications in the program, and yet no one who talks about canceling student debt talks about stopping the problem, which is highly correlated to the federal government's takeover. So I was just concerned by your response, you know, at the Senate Banking Committee about student loan forgiveness and kind of an unconditional support for whatever President Biden decides.
All I said is that the president is currently considering the options and trying to formulate his position on this matter.
Well, let's hope he sees the moral hazard of doing that. And frankly, you know, the people best equipped to pay back loans sometimes would be the biggest beneficiaries. And so the biggest debts are borne by people that are overwhelmingly, thankfully, in a position to repay their loans.
Many are.
And lots of people have debts that could be forgiven and have big impacts on the economy, and they didn't have the same kind of challenges. So that aside, look, we were just talking about the crypto markets, and obviously everything in the news over the past couple days is related to the markets being down, but overwhelmingly crypto being down at an alarming rate. And just a bit ago, you said, we're so concerned about runs on stable coins and the hazard of stable coins to the market. But my colleague, Mr. McHenry, started off by making it clear that algorithmic stable coins have a different risk than a one-to-one fiat or a one-to-one commodity-backed. There's not even fractional reserve banking there. There's 100% of the assets liquid and available. So would you like to qualify your distinction in terms of fear of a run?
Well, it depends on the backing of a stable coin. Terra is algorithmic and doesn't really have a backing as such. Tether
Tether is a time bomb, and it operates completely outside U.S. markets. So, and it is maybe fair to say that they are more like a money market fund, but an unregulated one, because we don't really see the transparency and disclosures. But others are regulated as New York trusts. Most of the stable coins in the United States are well regulated as New York trusts. So do you see those at the same kind of risk and same regulatory approach?
Look, I just think there needs to be a comprehensive and consistent regulatory approach for stable coins because of the risks they can pose to the financial system. And I think that on a bipartisan basis, we ought to work together to make sure stable coins that are introduced have such a regulatory framework.
Yeah, I think you can't treat algorithmic stable coins the same as something that's
haven't proposed to do that.
Okay, yeah, so just common framework, but not common for algorithmic. But Secretary Yellen, I had a number of members who wrote to you earlier about Section 6050I provision, and it was rulemaking for 8603 of the Infrastructure Act. And this was a requirement, a reporting requirement to the IRS on, transactions in crypto that were supposed to mimic things that are cash transactions. And so it's a very complicated ruling, and it's also technologically not entirely feasible for digital assets. Treasury issued some opinion about it. Would you consider, what's the process of the rulemaking right now?
I'm sorry, I'm going to have to look into that and get back to you.
Right. Thank you. My time's expired, and I yield.
Gentleman's time has expired. I now recognize myself for 5 minutes. Madam Secretary, there are those who believe that if you don't vote for legislation, you have to denounce it as ineffective. The American Rescue Plan was effective legislation. And here's what my colleagues didn't vote for. They didn't vote to help those who were unemployed during a pandemic. They didn't vote to save small businesses during a pandemic. They didn't vote to provide vaccines and to distribute that vaccine to those who needed it during a pandemic. They didn't vote to help children in schools during a pandemic. They didn't vote for food for children during a pandemic. And they didn't vote to provide for working families during a pandemic. They would call all of that inflation. But I believe that at some point the American people will understand that there were many of us who were trying to save the economy and prevent it from sliding into a deep, deep recession, and to help persons who were suffering during a pandemic. Madam Chair, you've spoken quite well on this topic this day. I don't want you to entirely repeat yourself, but there was a pandemic, and the American Rescue Plan was there to do what the government should do during a pandemic. Would you kindly give us additional thoughts on how the American Rescue Plan prevented us from sliding into a deep, deep recession or possibly something worse?
We saw unemployment rise after the pandemic struck to double-digit levels, something we hadn't seen in the United States in decades. And there was immense suffering. The pandemic unfairly struck those low-income minority workers, those least able to bear its consequences.
Who went to work every day, many of them, Madam Secretary, risked their lives to make sure that there was food available for those of us who could stay at home and work from home during a pandemic.
And we saw cars lining up in parking lots to get food at food banks.
And Madam Secretary, many of them, while in line, their cars ran out of gas during a pandemic. Please continue.
And we worried that many people would lose the roofs over their heads.
Kept people from being thrown out on the streets. That's what the American Rescue Plan did during a pandemic. Please continue.
And we worried that children would suffer and experience homelessness or loss of access to education, that families and workers would be permanently scarred and never really be able to get their lives back on track.
Madam Secretary, if I may just say this, because I'm going to end this with my 5 minutes, but I want you to know this. I appreciate what you did. Pandemics are not things that you can predict. And we didn't know what the actual solutions were. But we saved a lot of lives. We helped a lot of people who were suffering during a pandemic. And when we hear people say, oh, you spent too much. Well, we spent too much on unemployment during a pandemic. We spent too much to save small businesses during a pandemic. We spent too much to provide vaccines and to distribute that to people during a pandemic, to help schools and school children, to keep people from being thrown out on the street, to provide for child care as parents had to work. It was a pandemic. And it was more than inflation at risk. Lives were at risk and many were saved. I thank you for your service, Madam Secretary, and I yield back the balance of my time. And with that said, Madam Secretary, your testimony has been very valuable to us today. Without objection, all members will have 5 legislative days within which to submit additional written questions for Secretary Yellen to the chair, which will be forwarded to her for her response. Secretary Yellen, I ask that you please respond as promptly as you are able to respond. Without objection, all members have 5 legislative days within which to submit extraneous materials to the chair for inclusion in the record. The hearing is adjourned.